Hello again, and welcome to Ag Marketing. This is Unit 4. We're going to talk the futures markets here. And as we get along in this semester, clearly we're getting down to some of the more difficult content stuff when we get into futures markets. There'll be two segments in this particular section, so let's dive into some of the content stuff that we have to offer you. First, when we think about the futures exchange, and I've tried to create a diagram here to show you just kind of where everything is connected and interconnected. So if we think about the futures exchange as kind of the centerpiece of the puzzle here, where we're trying to bring buyers and sellers together, we kind of have an interconnected web that futures exchange is involved in. And if we go to the bottom left of your screen and kind of go around clockwise, the futures exchange, in effect bringing those buyers and sellers together, is open and competitive to trading. So you'll have buyers and sellers both active in the market at any one time, all the time, any day that the markets are trading. If we move up to the upper left of the screen, the futures exchange also establishes and enforces the rules. They have the guidelines for, how far up a market can trade, how far down it can trade, how many positions you can have open, and making sure that all business transactions are closed at the end of the day. Moving to the right, seller contracts for future delivery. They kind of make sure and regulate those and make them clear for everyone that's trading. And then the buyer, they enforce that the buyer agrees to accept delivery of the grain or that contract value at any one time. So that's what the futures exchange, kind of the role that they play in futures trading. So those that run the Chicago Board of Trade, basically, that's what they are in charge of. If we move on and think about the futures markets here and kind of think about, why would a farmer want to participate in the first place? First things first, of course, to set hopefully a floor price for crops. Now, of course, you're going to be, utilizing the futures markets to help augment or enhance the price that you have in the cash market. But you're going to utilize that to try and help support your bottom line. Also, hopefully, to lock in profits. And you need to know for sure, whenever you start playing in the forward cash contracts like we talked about in Unit 3, or futures contracts in this particular unit, where your profitability line is at. So what is your break-even cost? How much does it cost you to plant an acre of corn? How much does it cost you to grow an acre of soybeans? How much does it cost you to make a pound of milk? So knowing that break-even mark then sets the tone for what marketing strategies you put in place and how aggressive you get and when. So a few rules to the right-hand side or guidelines is contracts have to be offset with equal and opposite positions. So if you take a forward or a futures contract option and go long, you buy, you'll eventually have to sell to close that position. If you do the opposite and you enter the market in a sell position or go short, you'll eventually have to go long and buy and cancel that position out. But that gives you some flexibility because you can do either or depending on what the market dictates and how you may be able to capture some profit. Usually this helps a producer separate the time of pricing from the time of delivery. As you know, we have a rather short harvest season most of the time when a lot of the crop comes to market. Now, of course, not all of it has to come to market then, but it separates when you price a crop versus when you deliver a crop. And hopefully, like we said, it adds profitability to your bottom line on the farm. There's a whole list here of commodity exchanges, and we primarily reference the Chicago Board of Trade that's at the top, and that's the main player in terms of grain merchandising as well as many things, as well as the Chicago Mercantile Exchange. And those two have now merged because the Merc takes care of the cattle, whether it's live or feeder cattle, hogs and pork bellies, orange juice and things of that nature. But there's certainly some other grain exchanges listed here on the slide that are important to note as well, that are main trading cogs. But the Chicago Board of Trade, Chicago Mercantile Exchange are the big two. Moving on, when we think about, how are prices established? How do we come up with, how does the board know what to trade on a daily basis? So we think about price determination. Well, buyers and sellers react to supply demand, and you'll hear experts in the marketplace talk about, whenever they're analyzing what's going on, they'll talk about fundamental analysis or technical analysis. So what do those things mean? Well, fundamental analysis is the supply-demand relationship. What's going on pushing supply and demand, and that elasticity one way or the other. What market forces are at play? For example, droughts that may go on, or widespread shortages in grain, additions to the cattle market. What market forces are at play there? And then price level determination by speculators. At what price point is a speculator willing to get into the marketplace? That's fundamental analysis. Technical analysis, then, on the bottom right-hand marker here, is analysis by chart interpretation. You'll hear a lot of folks, whenever they do their market reports, refer to the charts. And there's a lot of shapes and different indicators that technical analysts look at to try and predict which direction the market is moving, to help advise you on what positions to take. And there's a lot of different chart interpretations that historically give some good reference points. They'll also be following the volume and open interest trading every single day. Lots of trading indicates lots of interest, lots of activity in the market, which may move a price up or down depending on what direction the market is kind of flowing at the time. And then they'll also be calculating moving averages. So that's kind of how the price is determined on a daily basis. A lot of these factors going into play. But we're going to drill down a little bit more deeper on a couple of these things. First things first is, and we've got an example here of the price of coffee. And you could substitute that coffee for corn or soybeans or wheat or milk, whatever it might be. But we're going to start, I'm going to take my mouse here and drag it through the middle. We're going to start with this D1, or original demand curve, okay? So at the quantity demanded 1 and the price demanded for 1, you'll see at any slide up and down, left or right, of the demand curve 1 here in the middle, you'll see when demand kind of comes down, or whenever there's whenever price goes up, demand is going to come down, or the quantity is going to come down. Whenever price goes down, demand is going to go up. Now, what causes these other shifts? Up to demand 2 or down to demand 3 curve? So let's say for a moment that we have a drastic increase in price. A shortage of corn, drastic increase in price. So a shift in that demand curve would go over here, let's say a brand new use for corn. So the demand would exponentially grow out here to the quantity 2, and farmers would eventually meet that demand. And then you would slide along this particular demand curve. And you'll hear analysts talk about a shift in demand. And it takes a pretty large market movement in order to make that happen. Consequently, if you can shift it right and increase demand, you can also occasionally shift it left and decrease demand. This would be maybe just a drastic oversupply in the marketplace, where there's just simply, it falls off the chart in terms of price action. So that means we have to drastically draw back the quantity supplied in order to meet the demand. So that's kind of how this looks in terms of a shifts in demand curve. So it's kind of interesting to look at those two different things in terms of what happens. So a good example kind of going on right now is for a little while here, we did not do much trading with China, obviously the #1 populous country in the world. And now that trading has picked up, and so therefore we have a little bit of a shift in demand, which is now taking out some of our carryout for the year, and therefore shifting price a little bit. So we'll see how that goes. But those it takes big, massive changes to shift demand curves one way or the other. Consequently, if you can have shifts in demand curve, we know that they are also there is also a shift in supply curves. So, and these are obviously angled the very opposite way. So if we start with the red line in the middle and shift in supply, and you can go anywhere up and down this line with a related price at a quantity supplied, whether it's, let's say in million bushels of wheat up and down in this supply curve, so it's a fairly wide range. But let's say we all of a sudden shifted that supply curve outwards. We moved, let's say, 40 million acres away from soybeans and shifted them into wheat. Well, then we're probably going to also shift that, as we shift that supply, we're going to also shift that price as well. And so, until things kind of even out, you may see a big high price demand, a price point for that. But that eventually tails off. We could also see, let's say, a drought caused, and therefore the supply tightens or the supply curve shifts inward. May we lose about 10 million acres of wheat production, due to a drought or something of that nature, and therefore the supply tightens drastically, and then we see a drastic shift in supply. These are things, and I know this sounds a little confusing, and I'm trying to explain it the best that I can, but these are the things that chart analysts look at, is where's that supply-demand elasticity movement? Where's the market going? How do we shift those things around in order to increase demand for corn? For example, pursuant to 9/11, 2001, and when gas really started to tighten up, and then over the next few years, ethanol really came into play, and we shifted the demand curve greatly because ethanol started to become really popular and a big competitor to gas, to gasoline. And so that added several hundred million bushels of demand to the corn market. Well, what did grain farmers do? Of course, we do what we always do, which is respond by making more supply. So we added supply, we added production, we upped corn yields greatly to match that new ethanol demand. And now we've kind of maxed that out. And so demand is now shifted backwards. We kind of, price of gasoline has checked back quite a lot. As you may or may not remember, gas was more than double what it is at this point in time, or around twice as much a gallon as what you pay currently at that $2.20 range. So that clearly shifts demand and supply. So now we're dealing with an oversupply and trying to get those acres back into check. All right, so put yourself in a futures trader position. You have on one hand the speculator who's attempting to anticipate market price movements. They're going to assume a pretty substantial amount of risk that a hedger, which is a hedger is most likely a producer, is kind of trying to avoid. Most farmers are a little bit risk averse, but a hedger needs a speculator. Otherwise, the market forces wouldn't exist as they are. A hedger then is typically involved in owning the product they're producing, the physical commodity that's traded in the marketplace. So the producer or the hedger needs to have a position in the futures market that's opposite to the position in the cash market. So they're generally, a hedger is going to have a long-term outlook. They're long in the market, and by that I mean you've already bought the seed, it's already planted in the ground, it's already growing. You're inherently long the crop, but you will eventually have to short it and sell. So you're trying to lock in profitability. But those two are both connected inherently in a futures trader position. And both, what either do affects the other one's profitability. So moving on, if we look at the costs of trading futures, so if you want to trade, you've got to own a membership at the exchange or transact business through a brokerage house who has a membership, and that's certainly not free. So there's brokerage fees that apply whenever you enter into trading agreements with different brokers and do different things. And there's a commission for each transaction. Here are the standard contract sizes. So as we've mentioned throughout the course, just a quick reminder, for the big three here, when we talk about grains, 5,000 bushels each and every contract. So if you trade 10 contracts, that would be 50,000 bushels. And then feeder cattle, live cattle, and hogs are either 50,000 or 40,000 pounds. And then generally it's about $60 to $75 commission fee or trade fee per contract every time that happens. We're going to wrap it up there for segment 1 of our futures market lecture video. And we'll resume here and go through some examples of how to calculate futures markets, trading positions, and whether they're profitable or not. Thanks for tuning in.